In this video, I'll be showing you the only liquidity that you can apply right now to improve your win rate and your win ratio. Now, the first one I want you to get yourself used to is your ability to identify area of support and resistance on the chart. Now, let's take a look at this. In this case here, market moved to this point, area of support, came down. Second touch here simply means, okay, we have our support level. And what happens, the market will induce a lot of people to start shorting this market. And when it gets here, it induces them to buy. This is resistance and this is support. As a trader, you should be able to identify this, especially a smart money trader. We do not want to be trading at areas of what? Support and resistance. Instead, what we need to be doing is, once you identify this, when you identify this now, what you need to do is to look above and below for a point of interest, okay? For a point of interest. So you wait for market to take that liquidity, okay? When market moves from here, for example, you wait for market to take that liquidity. Once the market grabs that liquidity, you can decide to enter based on the point of interest above. Then from there, you see price moving to the downside. And also, you must also aware the ones below, because that can be a kind of obstacle for this move, depending on your directional bias. In this case, I'm not talking about bullish or bearish bias, okay? But try this, back test it. When you see area of support and resistance, look for POI above and POI below. When you apply this alone, it should improve your win ratio. Now, meaning these are what? Liquidity. You'll be able to spot liquidity easily with this. The next one you need to also look at is bearish and bullish what? Quasi-model, or what they call a chalk. Now, in this case, we have this low taking out this high. Then we have a break to the downside. This is a what? A chalk, a shift in order flow, a shift in market structure, or a quasi-model. When price does this, market move up, came down, break this high, and at the same time broke out from this low. Now market move up, failure to create a lower low. You know that this is an inducement. Immediately, you then look for POI above where you want to be shorting from. In this case, yeah, you wait for this to be taken, because this now is an inducement. This is liquidity, okay? This is liquid. If you have entered this trade from here and price failed to take out this low and created a swing point, you can end that trade. Then wait for price to take that high, or you can trade a buy from here to take out this high, because this high is an inducement. Now, what makes an inducement powerful? It gives the point of interest a higher probability of succeeding, okay? When you see a point of interest before or after a POI, a liquidity inducement, then it gives this point of interest a higher probability of what? Succeeding. Meaning, a lot of people will be looking in here for some reasons, either in the lower time frame chalk. You will see a lower time frame chalk in here, okay? And they will be looking to trade that. And when they take that trade, it ends in a loss. Market takes that liquidity and then head to the downside. This is for a bearish what? QM. The same thing applies for a bullish QM, okay? You can simply wait, take your trade, or you wait for this inducement to form, because most times market will create inducement and then it moves. In this case, failure to create a higher high, this is an inducement, like a weak low. Your weak low is an inducement, okay? Is a liquidity, and market needs to take that, tap into a higher probability point of interest. Why is it higher probability? Because of the weak low, okay? Failure to create higher high. Price came in here, you know this is liquidity. By the time you start looking at the market in this form, identifying liquidity, you'll be able to do a better job week in, week out in the market, okay? Now, the next one here is a trend line, okay? Your trend line, the way I use trend line, I don't use it to place trade here and there. I use it as a form of what? Target. If I'm entering from a higher time frame, or even from the time frame where I'm seeing this trend line, I know that okay, my target will be to clear the trend line liquidity, because the market most times will come below, clear this trend line liquidity, and probably tap into a point of interest to continue the push to the upside, because all of this was to induce buyers to step into the market, whereas market can simply reverses on them, especially during the news, take them out, tap into this, and then we continue. So your ability, once you identify this, you can stay put and wait for price to get to this level, clearing this liquidity if all your analysis is intact for a buy. Okay, the same thing applies for a sell. We have a trend line to the downside here. You do not engage in here. Most of the other blocks you will be buying or selling from here are low probability other blocks, because eventually price will end up sweeping that liquidity, tap into the external one above the trend line, and then continue with the bearish move to the downside. Another way you can be looking at liquidity is looking at sessions high and low. Okay, when you check your chart, mark out the Asian high and Asian low, mark out the London high and London low, because it might help you in knowing which liquidity market wants to take. Like for example, if the market wants to be bearish on this day now, the market might decide to take the Asian high before moving. Okay, that Asian high is simply liquidity. You can also see that is liquidity, and you include that with your analysis. I'm not saying you should go to the chart and start looking for Asian high and Asian low and start looking for a way to target them. No, there are sometimes this Asian high will be a protected high, especially with very strong downward trend. The Asian high will be a protected high. Same thing for a strong bullish trend. The Asian low will be a protected low. But what I'm saying is this is a way for you to understand liquidity. Okay, I know liquidity is seated in there, so that it shapes your analysis. If you bring in that idea into your analysis to now come up with a explanation, concrete reason to either go long or go short. Another one you can be looking at here is simply equal highs and equal lows. Equal highs and equal lows. In this case, market goes up, rejected from that area, go back there, forming a kind of trend line, but this is the beginning of a trend line, and this is also an equal high or relative equal high. Price comes down. So what you need to be doing, in case you see any formation in here to go for a bullish move, this will be your target. Liquidity are your targets. When you are entering a trade, liquidity should be your target. Before you enter a trade, liquidity should be the reason. Once liquidity is being taken, you are sure that okay, with a high degree of probability that the trade might go your way. Okay, liquidity is very important. When you combine that with structure, then you have a kind of edge in the marketplace. Other form of liquidity you can be looking at are simply daily highs, daily lows, or daily swing high, daily swing low. We have daily high and low, and we also have daily swing high and daily swing low, weekly high and lows, and weekly swing high and weekly swing low, monthly high and lows, and monthly swing high and monthly swing low. Like for example, here this is a monthly chart here. In this case here, each of these monthly lows are liquidity. For example, this low is liquidity. Okay, for a bearish move, we might be targeting this low, this liquidity. Just looking at the candle, you know that okay, this is liquidity. Monthly high and low are liquidity point. If price sweep this liquidity and trade back in, then I will know that okay, the next target will be this monthly high and low, and we have monthly swing high and monthly swing lows. They are also liquidity. The same thing with weekly. Your weekly time frame, like in this case here, you can see market went up, took out this last week high, went lower. So your, like for example, current situation here, we have this high, this weekly high and weekly low. These are liquidity points. Okay, the moment before you start analyzing, look at okay, which of these liquidity will price purge first before moving. Okay, you incorporate that into your analysis. Always bring in liquidity into your analysis. Same thing with daily. I stopped there at daily. Anything aside from daily, I'm not interested. I'm not looking at the 4-hour high and low. No, daily, weekly, and monthly only. Okay. So in this case here, for example, this is a week low here. Eventually, price will come in here probably after taking this liquidity here. Okay. Why this liquidity? This is a weak high. It fails to what? Break structure. So as a stand, we are at the risk of taking this high. Okay, so price can move up, clear this high into this POI here, into this POI, and then we continue the bearish move to the downside. These are just simple way of you analyzing the market. Okay, looking at liquidity point, area of support and resistance, and the rest. So that is, I will not be able to go through all of the examples, but you can go back, test them, check them out, watch this video again and again and again to master those things, so that your ability to spot them on the chart will be priceless, and to help you to make your trading decision. If you want to understand more on liquidity, I will see you in this video.